and welcome to North Berkeley Wealth Management's mid-quarter commentary. I'm Kate Campbell King, and I'm here with Brian Kozel to talk a little bit about where markets are at and what we're seeing that might come next. The topic of the day is coronavirus and the way it's spread around the world and what's happening to control it. But before we get into talking a little bit about that, why don't we summarize where markets have been recently, including last year, and the kind of risks we often see in the market and in the economy. Brian, can you give us a summary there?
Thanks, Kate. Indeed, there are concerns right now about the coronavirus and the spread of that disease as well as market impacts. But as you mentioned, before we dive into that topic, let's talk about where we are and what happened in 2019 as it just recently concluded. The market is coming off of a decade of fairly strong and consistent returns since the 2008-2009 financial crisis. And 2019 was no different, wrapping up that decade. We saw the S&P 500 up over 31%, international stocks as measured by the IFA index up over 22%, and bonds returning a healthy 8.7% on the year as measured by the Barclays Aggregate Bond Index. A lot of this growth in 2019 was fueled by interest rate cuts by the Fed here in the US, as well as central banks around the world. At the end of 2018, there was concerns about rising interest rates. That abruptly shifted course at the end of 2018 and throughout 2019. We actually saw 3 interest rate cuts, further fueling the appetite for risk-taking among investors and driving up the price of stocks, both here in the US and globally. And that is the backdrop that ran its course through the end of 2019 and found us at the beginning of 2020 with a bit of stability actually in the markets before this new risk was introduced. The risk that we're going to be talking about more today is that risk of a global pandemic, namely coronavirus or COVID-19 as it's been more scientifically named here, that originated in China and specifically in the Chinese province of Hubei and the capital city of Wuhan, and has spread throughout the world in smaller pockets, kind of sparking concern by investors right now. As we track the market for client portfolios, we're looking at a variety of kinds of risks. Some of it can be tracked more incrementally, seen and measured along the way. Things like rising debt levels, rising inflation, the trends in corporate earnings. Are they increasing over time or decreasing? There are also other risks that can impact the markets that are more sudden. These can seem to come out of nowhere. These include things like the flash crash that we saw in 2010, an idiosyncratic company failure like Enron declaring bankruptcy, or an unexpected outcome like the Brexit vote in 2016. When a risk seemingly comes out of nowhere and is less expected by the markets, the way it's digested can sometimes be harder to decipher. The market is analyzing it in real time. And a pandemic, the coronavirus namely, falls into that latter category of something that wasn't necessarily expected. And we, along with many investors, are seeing how it's going to impact markets, economies around the world, and if there's any shifts we want to make in our portfolios. And so, Kate, can you talk a little bit about where we're at right now?
Well, it's spreading. I think everybody's watching the news to see where there are more cases and geographically how it's spreading. And I think really one of the most important things that we're paying attention to is what sort of actions are being taken to stop the spread. These are mostly preventative actions, and they are having an economic impact, and they will continue to have some economic impact. China, put Wuhan on lockdown, but have also had all across their country, they have got limits on people's movements. They've closed factories or reduced shifts. Other countries, including the U.S., have halted flights or plan to have flights continue to be halted for some time.
In Italy, just this weekend, was noticing that Carnival was canceled, and they've even canceled parts of Fashion Week in northern Italy as they've seen a spat of outbreaks there.
Right. And in terms of what the economic disruption is likely to be all around the world, not just in China, that's a good geographic location to focus on. Austria, southern Germany, and northern Italy is a somewhat integrated industrial region. And so to the extent that Italy is closing things down, Austria is, I think right now, considering closing the border. They had 2 people come in that were suspected to have coronavirus. They did not test positive, but they're still thinking about closing the border. So closing borders, container shipping companies have reduced their spring availability by by 30 ships, which I think for the West Coast, we're talking about between China and the West Coast, adds up to maybe 10 to 15% of the capacity. So that would be a 10 to 15% decline there, along with air routes being canceled, borders being closed in the Middle East between Iran and Iraq and a number of other countries. They are being very careful how they allow, in particular, tourists who are coming for pilgrimage to cross borders. So I think all of those things together are indeed going to slow down industrial production. They're going to slow down economic activity generally.
Also, as we talk about different kinds of risks, there is the more measurable risk to economic activity. And you're talking about that, the fact that there's less, factories are closed. They're not producing. If container ships are being taken offline, goods are not being moved around the world. There's another element of risk too, which is the psychological risk, the fear that can exacerbate an event like this. And I think of that when you mention border closures. It's a big one that really sparks a different level of fear in a lot of residents. In the EU is one of the founding tenets of the EU is the freedom of movement of people.
Right.
And so if we're talking about a closing of a border between Austria and Italy, it's akin to Nevada closing its border and not letting people from California in. It's a union of countries in this case that have standing agreements in place for the freedom of movement, and that is being challenged in an event like this, and the ability to enforce quarantines.
Right. And if we bring it closer to home, too, in California, one of the preventatives that is a response to psychological risks is the canceling of many different conferences. And we've seen this globally as well. As you mentioned, in Italy, there are a lot of tech conferences, other conferences that producers have simply elected not to pursue, so that people aren't traveling, people aren't gathering, and there's less possibility for the virus to spread. You mentioned factories closed or production slowing. Ultimately, if you have enough inventory to get through a short-term disruption, this can be not so bad. And what you end up with is a delay in production rather than a true loss of production and a true decline in trade. I think depending on how long this lasts, and we don't know yet, will depend on how much actual impact there is to the GDP of various countries around the world and ultimately to the global growth numbers.
Based on early readings or prognostications around global growth and the impact there, how are markets reacting to this?
Well, it's funny because last week we had our internal market review, and we talked about the fact that there was cognitive dissonance going on in the markets, where we had this potential for really significant global impact, unknown, of course, but stock markets were behaving as if nothing was wrong. But that changed this weekend. Global markets are down significantly, 3 to 4% generally. And that's brought the U.S. market back to being flat for the year. Emerging market indexes are down about 10% for the year, so the impact there has been more significant. We see this as a good thing. because it's a rational response to uncertainty and to the possibility that we really could have a long-term economic impact from the virus. One other thing that, how China's position is in the global economy is very different than it was the last time a virus came out of China with SARS in 2003.
That's right. There's a lot of easy comparisons being made between the coronavirus and the SARS epidemic that took place in 2003. And there's two main ways that they're different. The first one is that the viruses themselves are different, not only in scale and impact, potential kind of death rates on them, but also kind of who they're happening to and when. And so we were just looking up. In 2003, China represented 8.7% of the world GDP. A sizable figure, certainly an important economy in the global landscape. In 2019, they represent 19.3% of global GDP. So almost 1/5 of global GDP is directly coming out of China. And so a more impactful epidemic, potentially pandemic like coronavirus, now in 2019, 2020, has the potential to be a lot more impactful than what we saw from SARS or even other past epidemics around the globe, making those risky comparisons at best.
And markets really are reacting. It's not just the stock markets that are finally behaving rationally. Gold is being pushed up as people feel more cautious. Oil has dropped significantly, in part because China's demand for oil is likely to go down, but also because global demand overall should decline in a situation of declining economic activity.
So we're talking about this is a specific kind of market risk, one that was more difficult to forecast or see coming. Markets, despite having retained some strength through much of this year, have finally started to price in some more potential risk here. We're seeing some declines in stock prices in the US, around the globe, as we were just talking about. Does this result in any changes in portfolios for clients? Are there actions to be taken here?
Yeah, I know that's a question a lot of people have on their minds. Should we do anything? To start with, our clients' portfolios are positioned for a range of outcomes. And when I say a range of outcomes, that means a range of economic news, a range of market behavior, so that they are resilient in various circumstances. And we currently do have a fair amount of downside protection built into our allocations. Ultimately, one of the ways in which we'll react to this is if market prices continue to decline, we will ultimately be rebalancing the portfolios in a way that buys in at lower prices. We are invested for the long term. Our clients have long-term needs, and so being able to make even some marginal purchases at lower prices ends up being a net positive. And one other thing I was thinking about with this is that the reaction to the coronavirus has been pretty dramatic, once the information had come out of China. And globally, there's a lot of preventative action going on. And ultimately, if that preventative action is effective, the short-term declines that we see may only end up indicating a delay and really only a small decline in overall economic activity by the time we get to the end of the year. If it gets worse and worse and closures and shutdowns and all of that continues significantly longer, the impact could be a good deal worse. We've seen global pandemics before, and ultimately their impact on markets has been fairly muted and fairly short term. Mm-hmm. As I say, with this one, if it does go on for a significant period of time and it's not brought under control, it could be more damaging. But for the moment, we don't have reason to expect that it's going to be a terrible situation.
I was actually on that topic. I was noting that this past weekend, Warren Buffett released his annually anticipated letter to shareholders. And in it, he talked about a variety of things, but he did touch on coronavirus and general risks to the market. And he said, quote, "If you're buying a business, and that's what stocks are, you're going to own it for 10 to 20 years. The real question is, has the 10 or 20-year outlook for American businesses changed in the last 24 to 48 hours?"
And we think the answer to that is no.
Precisely, is that we always anticipate short-term volatility. We don't necessarily know what the sources will be. But in terms of a long-term diversified portfolio, we still think the portfolios are in a good spot.
In the long term, we remain very optimistic about domestic markets and global markets and are positioned for growth over that period of time. And with that, I'll thank everybody for joining us, and we'll see you next time.